when you get interest rates obviously not going to come down as people expect, when you get a bear market developing in your normal sort of pharmaceuticals, tech stocks, industrials, and so on and so forth, when that really starts happening and people start thinking we're underweight in gold, you just see the effect on the mines share prices, which are right down at the bottom. They really are. Look at the effect on gold itself. You know, when people start going into ETFs or however they invest their portfolios into gold, there is no gold there for them because the central banks have been basically cleaning out the refiners. It won't be just a question then of the dollar going down rather than gold going up. It will be both dollar going down and gold going up. I think you could see the gold price by the end of this year moving very, very sharply upwards.
In a recent analysis, Alasdair Macleod, the head of research at Gold Money and a respected voice in the financial community, suggests that the Federal Reserve's upcoming approach to interest rates could significantly impact the short-term trajectory of gold prices. Macleod highlights the possibility of a dip in gold prices below $2,000 if the Federal Reserve adopts a more cautious stance during its meeting. The immediate market response to the Federal Reserve's decision to keep rates unchanged was trimming earlier gains, with gold trading within a volatile range of $20.30 to $20.40. Central to Macleod's argument is the belief that gold's fundamentals are shaped by central banks actively reducing exposure to paper currency, leading to increased gold accumulation. The World Gold Council supports this claim by reporting that global central banks, led by China, continued to increase their gold reserves in 2023, with a collective purchase of 1,037 tons. Macleod further notes the illiquidity of the gold market and a shift in investor sentiment toward gold. He posits that these factors, combined with a potential decline in the value of the US dollar, could lead to a significant increase in gold prices. He concludes by expressing the belief that gold prices could experience a sharp upward movement by the end of the year, given these conditions. Examining historical trends, when interest rates fall, gold and gold stocks tend to perform well. After reaching a two-week high of $2,055.89, gold prices have experienced a gradual climb in the past few months, following a dip in October. Adding to the discourse, a recent report by J.P. Morgan forecasts a continued surge in gold prices, projecting a move toward the $2,300 level in the concluding months of the year. Interestingly, this prediction aligns with Macleod's short-term outlook, suggesting a minor dip before a sharp upward movement in gold prices by the end of the year. Before diving into Alasdair Macleod's interview, subscribe to our channel and give this video a big thumbs up.
I would not be surprised. I mean, if we get, say, a slightly more cautious approach from the Fed on interest rates tonight, what we could see perhaps is an opportunity to hit gold back under the $2,000 level. And I would expect in that case it might bottom out around about the 1950, 1960 area, which is roughly where the 200-day moving average is. So that would be, if you like, a normal technical reaction, though the perennial gold bugs, you know, they will scream blue murder, but they always do. We're not talking about fundamentals for gold other than what the central banks are doing. The central banks basically are trying to get out of paper currency. You know, that's why they're accumulating gold. You know, the central banks are trying to get out of paper currency, which is why they're buying gold. And it's paper currency that we've got to look at. Paper currency is losing its purchasing power. I mean, you know, we've already spoken about the position of the dollar, where you've got a debt trap. I mean, just look at what's happening to the US Treasury debt, the debt mountain, and rising interest rates. What's that going to do to it? You can see that, I reckon, by the time the new ceiling is fixed, which is due to be done on January the 1st, 2025, we could be looking at total debt outstanding in the region of about 40 trillion. When it comes to the outlook for gold, we are seeing it's not so much gold at the moment. There's no interest in gold, as I said earlier. And also, if you look at the interest in gold, I mean, what are the ETFs doing? They're still being liquidated. The public are still selling ETFs. I mean, this is not a gold bull market. It's a bear market for currencies. But the one thing I would say is that portfolios are so underweight in gold and gold-related investments. We've got roughly $150 trillion worth of portfolios around the world. Everything from wealth funds to mutual funds to pension funds, insurance funds, the whole caboodle, about 150 trillion. The investment in that, in terms of gold and gold-related investments, is less than 1%. Now, when I tell you that in the past, before all the propaganda about how gold is a pet rock and forget it and the dollar is the new money and so on and so forth, we were looking at having a sensible portfolio exposure to gold, which is really like an insurance policy against all the other things you've got in your portfolio going wrong, of somewhere between 5, 10, maybe even 15% if you're really worried. We have less than 1%. Now, the point about that is that if that was to adjust 1% upwards to less than 2%, that is the equivalent of portfolio purchases of over 23,000 tons of gold. Now, the reason I say that is to just emphasize how illiquid the market is. Where does this come from? When you get a swing out of these wonderful tech stocks, which have been carrying everybody's portfolio through to the moon, when you get interest rates obviously not going to come down as people expect, when you get a bear market developing in your normal sort of pharmaceuticals, tech stocks, industrials, and so on and so forth, when that really starts happening and people start thinking we're underweight in gold, you just see the effect on the mine's share prices, which are right down at the bottom. They really are. Look at the effect on gold itself. When people start going into ETFs or however they invest their portfolios into gold, there is no gold there for them because the central banks have been basically cleaning out the refiners.
Macleod challenges the prevailing belief that interest rates are on a downward trend, contending that bank credit constraints might result in higher interest rates. According to a recent survey, a net 50.8% of banks tightened credit terms for commercial and industrial loans to medium and large businesses in the last quarter of 2023, up from 46% in the previous survey. For small firms, 49.2% of banks reported stricter credit terms, compared to 46.7% in the prior survey. Macleod also highlights the upcoming FOMC meeting, suggesting that the market anticipates a slightly softer tone, indicating an expectation of a more accommodative stance from the Federal Reserve. Despite the Fed leaving interest rates unchanged in its recent meeting, traders project 142 basis points of Fed rate cuts this year. Fed Chair Jerome Powell, while discussing the potential for rate cuts, mentioned that he doesn't think it's likely for the committee to reach a level of confidence by the March meeting. Analysts, such as Jigar Trivedi from Reliance Securities, believe that the Fed has kept the door open for interest rate cuts, providing support for gold. Let's get back to the interview.
I mean, the problem with the banking system really is it starts almost from the central banks downwards because, as I've said on your show before, the central banks are deeply into negative equity. If they had to behave like the rest of us, there would be the directors would be in jail by now. But these are government organizations, so they get away with it. But we've had this morning, and this is Wednesday the 31st, we've had news that the New York Community Bank shares have, collapsed is too strong a word, I suppose. At one stage, they've down about 40%, hitting new lows. This is not really good news. This is telling us the market is effectively having a run on the bank, if you like. I suppose that this is all going to come back into the headlines in the next few days. It might help gold, but I'm going to put that to one side for the moment. We'll talk about that later. The problem with the banking system is that when banks basically are overstretched and trying to reduce the risks that they face, then things start going wrong. And I'll give you another example. We've had the Evergrande collapse in the Hong Kong courts, where it was ruled that the proposed reconstructing wasn't going to work and so on. As I understand it, the value of Hong Kong property has taken a bit of a dive on it. Now, this makes one wonder. I mean, I'm sitting in the UK. We've got two banks in the UK which are very heavily involved in Hong Kong. Hong Kong Shanghai Bank, obviously, which now calls itself HSBC, and Standard Chartered. I mean, these are two banks very, very busy in the Far East and particularly in Hong Kong. So I would not be surprised to see that questions will be asked about their solvency and so on. So that's likely to begin to impact the banking sector in the UK. I mean, when you get New York Community Bank Corp getting into trouble, I mean, we're not talking a major bank or anything like that. I have no idea what the size of the balance sheet is, but I don't think really it's all that important. But I think it's just the indication that this problem has not gone away. And furthermore, the interest rate outlook, I think, is being driven as much as anything by the tightness of bank credit. Why is bank credit tight? Well, bank credit's tight because banks don't want to lend money to businesses because they see business conditions at very, very best stagnant, and at worst, I mean, particularly up and down the country, small and medium-sized businesses are struggling and they need cash flow replacement, and they go to the banks in order to have an overdraft, and the banks are basically saying either no, or if they do offer overdraft facilities, it's with goodness knows how much extra collateral and all the rest of it, like directors' houses and so on, that they have to put up for collateral. And on top of that, the rate is high. So this idea that interest rates are falling, forget it. When you get a shortage of credit, the rates actually rise. And I don't see anyone actually fully understanding this in the, in all the commentary that I read on the internet and hear on YouTube and the radio. So I think we've got the FOMC meeting that's going to play out a little after this is recorded. And the market hopes that there will be a slightly softer tone.
The gold market continues to hold support above $2,050 as the Federal Reserve provides few hints on when it will start cutting interest rates. As expected, the Federal Reserve left interest rates between 5.25% and 5.50% on Wednesday. However, analysts note that they have been more interested in any potential forward guidance from the central bank regarding when its easing cycle will begin. How do various factors discussed in the video contribute to the overall sentiment and outlook for gold prices in the coming months? Share your thoughts in the comment section. If you liked the video, please subscribe to our channel and remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.